Hello, class. This is Professor Reynolds, and this is Module 4. And in Module 4 for the week, you're going to really be looking at Chapters 11, Chapter 12, and Chapter 14. Chapter 11 has to do with currency transaction hedging. Chapter 12 has to do with translating statements from foreign entities that are owned by a U.S. subsidiary. Chapter 14 is going to be dealing with partnerships. So that's a whole different subject matter. I'm going to need to do this in 4 different videos. So the first video is going to cover the basics of Chapter 11, and it's going to cover the problem set in Chapter 11. And the second video is going to be covering 11.5. Now, if you can do this, 11.1, 11.5, you can do these other ones here, and there's also 11.8, I believe. And then I'm going to have a video on this, Chapter 12, which will be talking about translating financial statements. And then lastly, I'll have a video on partnerships. The software I'm using only allows me 30 minutes, so that's why I have to break it up. So again, there'll be 4 videos. Under GAAP accounting, one of the criteria is the monetary unit, as you can see here. What it means is that if you're an American company and you're on the New York Stock Exchange or NASDAQ, then you have to measure everything in dollars. And that makes sense because we're Americans, we use dollars, we understand dollars. If I said, hey, that's $1 billion, you get a kind of a feel for what $1 billion really is. If it's a billion euros, you don't use euros, so you don't, you can do the translation in your head, but still it's not as easy. So if we have transactions between a US company and a foreign entity, we are going to measure those in dollars. Now, if you have an asset and it is designated in a foreign currency, then you basically have to, that asset, although the foreign currency may not change because the exchange rate changes every day, your asset or liability value changes. So here's an example of accounts receivable. And let's say that you are owed 100,000 euros that are going to be paid by the end of the year. Now, at the time of the transaction, if this is a result of a sale, then you're going to book the sale at the current rate at that time, which is called the spot rate. So in other words, the spot rate on March 31st was 1.2 euros for every dollar, or $1.2 for every euro. Okay, so it's going to take $120,000 to get 100,000 euros. All right. Now, June 30th, again, you are getting euros, but you have to determine what the dollar value is because, again, U.S. financial statements have to be in dollars. It would be too complicated to have some in euros, some in dollars, because then you wouldn't really have a clean understanding of how much it really is. You have to adjust this for what the current value is. So now the spot rate has gone up, okay? So the dollar value that we received has gone up. So when we made the transaction, we recorded a sale of $120,000, which is always going to be, that's going to be the sales. The actual currency is a separate transaction, and that impact is going to be a transaction loss or gain. So our value has gone up to 140,000 and we have to make an adjustment. So what we're going to do is we're going to debit accounts receivable and increase it. And then we have to credit something, and that's going to be transaction gain. On September 30th, again, we have to determine what our assets are worth. And so the exchange rate, unfortunately, has dropped. So the dollars aren't worth as much as they used to be. In fact, you can see that in total, we're going to lose $10,000 from the beginning. But we have to make that adjustment, so we have to reduce the balance of AR from 140,000 to 110,000. So that's a credit. The debit would again be transaction loss or gain. And so you could lose or gain just because of the difference in the exchange rates from one day to the next or from one quarter to the next. And so that's why companies engage in hedging, and that's what we'll talk about in the next video. But we're going to go into 11.1, and there are going to be several transactions, all right? And so we're just going to record these transactions at on the dates that that it happened. So the first one is that we purchased power tools in yen. So we purchased 10,701. Now this is the spot rate, okay? And that's what we could convert. So if we had to go on the day that we made this transaction, if we had to say, well, we've got to come up with 1.53 million yen, then it would cost us $10,710. So we're going to record that purchase. We're going to debit purchases. We're going to credit AP because we owe at this point $10,710, but we really owe 1,530,000 yen. On the 5th, we sold to a West German company in dollars. So we're going to record that in dollars. So they have the responsibility of delivering dollars to us. So they are basically taking the exchange risk, the exchange change risk. All right. Same thing in the next one. So we sold 18,000, and then but they owe us again in dollars. All right. Let me bold these just to make it a little clearer. All right. So again, the first one we recorded in dollars, but we're actually talking yen. The next two are dollars. So then on the 11th, we again purchased in Belgium. So we are going to owe 801,282 Belgian, whatever the currency is. I think it's listed, but I don't have the problem up right now. And at that time, on that date, 801,282 Belgian currency was worth 25,000 USD. So again, we're recording in USD. On the 16th, we're going to make a partial payment of yen. We're going to pay 930,000 yen. All right. So we have to first determine, well, what was the balance of that 930,000 yen on the day we made that transaction? Because we want to reduce our AP balance by that amount. Remember, we put the AP balance on at the spot rate on the 3rd. Well, the spot rate has changed. And so we are going to eliminate 930,000 of the original amount. So whatever was due, because again, we recorded 10,710. So we have to reduce the AP by the equivalent. So that would be 930,000 times the spot rate on the date that we made the transaction. But the actual cash is going to be the 930,000 times the current spot rate. So we actually have to come up with more cash than what we had originally anticipated. And so again, debits have to credits, or actually less cash, I'm sorry. So we are going to have a transaction gain of 465 All right, so we recorded partial payment. Now we're going to record the payment of the Belgian currency. So the Belgian currency, of course, we booked for $25,000. So we're going to get rid of the AP for $25,000. But the Belgian currency is going to be 29,327. So let me just make this equivalent. All right, so 29,327. All right, so that's the cash we actually have to come up with. And that means that the difference, debits equal credits, is going to be a transaction loss of the difference between, really because the currency at the time changed from 0.0312 to 0.0366. So Belgian currency became more expensive, and so we have a transaction loss. The 1810, again, they owed us in dollars, so they're going to have to pay us in dollars, so that's really not an issue. It is for them. All right, and then we're going to finish paying off the currency. So at the time, we had 10,710. We reduced the AP balance by this 6510. So the difference between those two is going to be the current balance in AP for the original transaction. Okay. Originally, we booked 10,710 in dollars. We removed 6510, so the balance is going to be the difference. Now, the cash that we have to come up with is it's going to be the remainder, the 1,530,000. You can see less the 930,000 yen we already paid. So that's going to be a difference of 600,000 yen times the current spot rate. All right. So what we're going to need to come up with again is $4,500. And so you can see here that really we're ending up paying 11,628 over the 10,7. Well, that actually doesn't work because we paid a different exchange rate. So anyway, we ended up paying that. We had a remaining AP balance of that. So the difference, debits equal credit, is a transaction loss of 360. So this is a situation where you can see that we lost some money because the exchange rates became unfavorable against the dollar. So waiting on getting paid and waiting to pay worked to our disadvantage. And so sometimes to alleviate that, we're going to be doing hedging. And so we'll talk about that in the next video.